Hello everybody. I wanted to go over this budgeted balance sheet. One of the things that you may or may not have picked up on is that the budgeted balance sheet relies on all the other budgets that came before it. What do I mean by that? So here's a master budget, and the budgeted balance sheet is the last in the series. If you were doing a budgeted balance sheet, you would have all these prior budgets available to you. Here, in this problem, they've given you the cash budget and the budget income statement, but they didn't give you the prior things. Instead, they gave you little snippets of data that would have been available on these prior sheets. For instance, let's look at the selling and administrative budget. Notice here that we have total selling and administrative expenses, and then we have a reconciling item before we get down to selling and administrative payments or cash disbursements. It'd be nice if that was spelled correctly, wouldn't it? And you can see here the reconciling item is depreciation. So the difference between expense and payments is a non-cash expense, depreciation. That matters in the problem that we're looking at. The other thing we have here is a reconciliation of finished goods. You don't have that in manufacturing overhead. You don't have that in the problem that you worked on, because it would just be too long of a homework problem to ask you to do an entire master budget. So those two little pieces matter for this one. So let's work through it, and we'll see what I'm talking about. Okay, cash. You've got a cash flow budget, so you know what ending cash is. That's going to be here. But they want you to record the increase and the decrease to cash. So here's our receipts. And there's actually a receipt in here. They got a loan, and when you get a loan, you debit cash and you credit notes payable. But they want, for this particular homework assignment, they want you to add up the net disbursements. All right. And then, of course, we want it to be a positive number here because we're doing it as credit, not as a plus minus. Okay, and so we can check beginning plus debits minus credits. And that should match, and it does. That's good. Okay, accounts receivable, they said all sales are on credit, so those would be debited to accounts receivable. And then we would be reduced by your receipts. And then this formula would still work, that beginning plus debits minus credits. So there's your ending accounts receivable. And then for direct material, what makes it go up? New purchases down here. And then what makes it go down is using, which they also give you down here. And so you can figure out what ending direct material is. So now for finished goods, what makes finished goods go up is cost of goods manufactured, which comes from work in process. So there is no beginning or ending work in process. And the reason I know is there's no line item for it in between here. So this particular, that's pretty subtle, but this particular company apparently starts and finishes all their things within the period. So it could be a perishable product, who knows? But for whatever reason, they don't have any beginning or ending work in process. That's not that unusual, actually. So that means that what went into cost of goods manufactured went to finished goods. So what went into cost of goods manufactured? Well, the materials used, and the direct labor used, and the manufacturing overhead. Well, I have manufacturing overhead payments, and then I need the manufacturing overhead that wasn't a payment, which would be your depreciation. Now they tell you that this is the depreciation that's in cost of goods sold. It's not quite right, but it's all we have. The depreciation expense that went into overhead would go to cost of goods manufactured. And if cost of goods sold was the same, in other words, there was no beginning and ending in finished goods, they would be the same number. Here you can tell there's beginning finished goods and there's going to be an ending finished goods. So that's a not quite right little minor flaw in the question, but we'll just have to live with it. What's the credit to finished goods? Your cost of goods sold. So there's our ending finished goods. Property, plant, and equipment. We do see here that some equipment was purchased. And we don't see any sign that anything was disposed of, so we don't have to remove the cost of any disposed assets. How would we know if there was? There might be a gain or loss on disposal. So we don't see anything like that here. We also don't see any receipts for the salvage value of disposed items, so we don't, it doesn't look to me like there's any disposals. Cumulative depreciation. So this is going to be more negative by the amount of depreciation. So depreciation is that 18.1 they already told us about, and it's the remaining depreciation that's in selling general administrative is the difference between the expense of selling general administrative and the payments. So that's 8,000. So then we would have this minus that. So it would be bigger, more negative, right? All right, so let's add this up and see what it is. We don't want the date in there. All right, and then accounts payable. So what did we buy on credit? Those purchases. All right, so buying on credit would increase the payables, so that's going to be a credit. All right, so those. And then what did they pay on that over here? These are the payments for direct materials. And now for the ending balance, we do beginning plus credits minus debits, because these are liability and equity accounts, so they work the other way. And that's true for all of these. We don't have any contra liabilities or contra equity. Okay, taxes payable. So tax expense is going to increase the liability. Payments for taxes is going to reduce the liability. There we go. And then there were no stock transactions that I saw. There were no dividends, so we're not going to have any debit to retained earnings, but we do have net income. And let's see if we balance. Okay, let me know if I can help.